Hello guys, this is Raj here. Welcome to my channel, and in this video we are going to discuss about how to filter the false signals provided by the engulfing pattern. As we can see, engulfing pattern is a more trusted, reliable pattern for reversal of a price. But you are trading for a while, you might have noticed that there are some false signals provided by the engulfing pattern. So, how to filter the false signals provided by the engulfing pattern? Let's see how we can filter out those false signals and make engulfing pattern really 90% winning ratio pattern. Let's roll the intro and I'll see you on other side of the video. Welcome back guys. For those who don't know what is engulfing pattern, here is a little intro about the engulfing pattern. Engulfing pattern is a strong reversal pattern occurs in a candlestick and which is workable across all the time frame. And there are two types of engulfing patterns. One is bullish engulfing and another one is bearish engulfing. And it is assumed that when we find a bullish engulfing pattern, the market is expected to go up at least for a next time frame of a candle. And if a engulfing pattern is bearish engulfing pattern and it is believed that the market is going down at least for next one candle. There are certain conditions to be considered to qualify a pattern as a bullish candlestick pattern. The first condition that it should happen on a support area, and to take a trade we need to specify some of the conditions to be fulfilled before taking any trade. In this image you can see the market is coming down all the way through the resistance area, or you can say the minor sellers area, and it reached the support area. And in a support area you found a green candle which covered whole body of the previous red candle, and it should cover at least 20% of second left candle. Then we can consider this as a engulfing candle. But before taking trade we should observe there should be some distance between the minor sellers area and the close of the candle. If it satisfied these conditions, we may see or we may take the call option and the market is expected to go up for at least next candle. And now let's see about the bearish engulfing pattern. First and foremost thing to look at bearish engulfing pattern is it should be formed at the resistance level, and bearish engulfing pattern is considered as a bearish reversal pattern. The market is expected to go down at least for next one candlestick if this pattern is occurred and all conditions are fulfilled. You can see in an image that the market is reaching towards the resistance area all the way through the support, and on the resistance area a strong red candle is formed which completely covers the previous green body and 20% of second left candle. Guys, what it represents? It represents that The buyers are interested. The buyers are taking from the support area, and as they reach towards the resistance area, they are thinking the price of the asset is more costly, and you can see these wicks represent that they are not interested, or they are thinking again to take the asset. And the red candle means now the sellers are activated and sellers are strong enough to push the buyers down. And if it completely engulfed the first candle means there are more sellers, more selling pressure is there than the buying pressure, and the market is expected to go down at least one more next candle time frame. But what we need to observe here is there should be some difference between minor bias area and the close of the candle. We will see in a further images how to where to take the trades and where to avoid the trades in upcoming slides. So this is about bearish engulfing. So guys, the thing here is, here we are filtering signals provided by the engulfing pattern to make the pattern more accurate. Yes, of course, we may miss some of the winning patterns, but at the end result, the accuracy of the engulfing pattern is increased. So, before talking about bullish engulfing breakdown, we need to consider some of the points before taking the trade of the bullish engulfing pattern. Somehow, first we need to be confirmed whether we are on the buyer side or the seller side. That is, if the trend is uptrend, then we are only interested in buying, and we will not take any engulfing pattern which are bearish. Of course, I have framed some set of the rules how to be think whether to be on a buyer sides or on the seller sides. But the first rule to be remembered is when we are on the bear side, we are not taking any bearish engulfing pattern, no matter how strong the signal is, no matter where it occurs, or no matter what is high probability of winning that bearish engulfing pattern is, but we are on the buyer sides and we are not gonna take that bearish engulfing pattern. And in the same manner, when we are on the seller side, no matter how strong is the bullish engulfing pattern, no matter what is the winning ratio or winning probability of that bullish engulfing pattern, we are not gonna take that bullish trade. So I think it is clear, guys. So before entering the trade, we must make sure whether we are selling side or the buying side. And next, we can think to take the trade or not. Now, assuming that we are on the bear side, let us break down the bullish engulfing pattern. Let us move and let us analyze the bullish engulfing pattern to trade. So what is the first condition here? For bullish engulfing, we should be on buyer side and we will not going to take any bearish engulfing pattern now, no matter how strong it occurs, no matter whatever the winning probability of that bearish engulfing pattern, we will not changing our side from buyer sides to seller side. This is the first condition. And second condition is that we are going to take the trades when all these conditions are met, which are shown in the figure. Here we can see in a diagram that we have drawn a resistance area, minor buyers area, and support area. I am going to show how to draw exactly this level at the end of this video. So stay tuned till the end of the video. But we should draw this area first. After confirming that we are on the buyer's side, we are hunting for only bullish engulfing patterns. And the bullish engulfing pattern is considered as valid pattern when it met the following conditions. And in this image, you are seeing the case 1 of the bullish engulfing pattern. This is the resistance area, and this is the minor bias area, and this is the support area. One thing what we have to look is the engulfing pattern should be occur at the support area, and the green candle should be cover at least 20% of the second left candle, and there should be the distance between the minor bias area and the close of a candle. There may be some wick, some little wick here, or there should not be any wick. That's fine. We call the candle with no wick at the both ends is called as Mozuboru candle. And another thing what we need to observe here is there should be distance, guys. And if there is no distance, we are not going to trade. And if there is a distance and it is occurred at the support area, then the market is expected to go up for at least next one candlestick. And we are going to take trade as a call option here. And in a second image, you may be observing that this is also a valid bullish engulfing pattern. But what you are observing that here we can find a wick at the top of the candle. But what is most important part here is the green candle should be closed above the 50% of the candlestick's body, and it should be closed more than 15 to 20% above the previous red candle's body. But the most important rule here is the green candle should be closed above 50% line of the body, and the wicks percentage should not be more than 30%, and there should be distance between minor buyers area and the close of the wick of the candle. If there is a distance between minor bias area and if the candle is closed 50% above its own 50% line, then we can take the call option here, and the market is expected to go up at least for next one candle. So this is the second condition where we are taking the call option. Now we will see what engulfing pattern trades we need to avoid. This is the image representing the engulfing signals we need to avoid. As you can see in the image, this is the resistance area, or you can consider this as a seller's area, and this is the minor bias area, and this is the bias area, right? And here we are seeing three red candles there, and after the three red candles we found a green candle sharing the same low, and we are assuming that it has a engulfing pattern. And here we may be tempted to place a call options, but one thing we need to observe that the candle is closed below 50% line of the same candle, and the wicks percentage is also of 50%. So it will not qualify my second and third rules, at least for me to consider as a candlestick formation as a valid bullish candlestick. The candlestick should close above the 50% line, and the length of the wick should not be more than 30%. So it is failed my conditions, so I'm not going to take here call options. Why? Before it closed below 50% line of the candle, and the length of the wick is more than 20 to 25%. And in the next slide I'm seeing another image which needed to be avoid trading. Here also we can see the market came down from the resistance towards the support area, and in a support area a strong bullish candle is formed, completely covering the last candle and the second last candle. And as any of the traders may be very excited to see the strong move of a candle, and they are tempted to place a call option. But guys, at least for me, when I see the strong candle and there is no enough distance between the minor seller area and the close of the candle and high of the candle, I'm not going to take this call option. What may happen next is there might be a small retracement red candle, and then the market will go up. Now there might be an important question, whether this candlestick pattern will fail all the time. No guys, in some time it may happen like that. The market will go up straight from this position to the next candle, and there should not be the red retracement small little candle or a doji candle. That doesn't matter, because our goal is to filter the false signals. This case it may go up, and there are some chances that a small retracement red candle may happen at the minor seller area. So the probability of winning this call option is 50-50. So we are not going to trade this. Rather than in some conditions we can win the call options also, but there are chances that we may lose also, and we are not sure when we are losing and winning. We are not going to take trade, and that adds up to the accuracy of the pattern. Same goes with the first image also. Whether this candle surely it will now go up. not 100% guys. There are some chances that there might be a small red candle and then the market will move up, or there are chances that the market will move up straight from the close of this candle. But there are also chances that there we can get a doji candle or a small green candle, and which may reduce the accuracy of engulfing pattern. Even though there are some chances of winning this call options, we are not going to take this trade because here we want to increase the accuracy of the pattern. Similarly, now we are going to trace the bearish engulfing candle, whether we need to take trade or not. So before coming to the engulfing pattern, first thing we want to make sure that we are on the seller side and we are not going to take any engulfing bullish patterns. No matter how strong the bullish pattern may occur, how strong the bullish signal is, we are not going to take the bullish engulfing while we are on the seller side. So this is the first rules, and once we confirm that we are on the seller side, we are going to take the bullish engulfing pattern. As we can see in this image, this is a resistance area, this is a 50% of a close line, and this is a close of a candle, and this is the minor bias area, and this is the support area. And we are going to take the bearish engulfing pattern only when there should be a distance between the minor bias area and the close of the candle, and the candle is closed 50% above the candle's 50% line, and at least it is covered 20% of a second left candle. On a distance, we are going to take the put option, and it is expected that the market will continue moving down at least for one candlestick. And we can see the second pattern which we can take when these conditions are satisfied. The candle pattern is occurred on the support area and it is closed above the 50% line of the candle, and the length of the resistance is the length of the wick is not more than 30%, and there is a distance between minor bias area and the close of the wick of the candle. In this case, we are going to take the put option, and the market is expected to go down at least for the next 1 minute. And here is a kind of bullish engulfing pattern we need to avoid, is that if the body is closed below the 50% line of the red candlestick and the length of the wick is more than 30%, say 45%, then we are avoiding this trade. The reason is saying that we may face a doji candlestick here, or we may get a small green candle here, then the market will go down next candle. So the probability of winning this trade will decreases. For that reason, there may be the chances that we can win this trade. We are not going to take this trade and we are avoiding this trade. And same can happen here if there is no distance between the minor bias area and it's a strong candle. The next candle will go down red very strong, or there may be a small retracement green candle, and that is the reason we are avoiding this kind of long bearish candle with no distance between the bias area and close of a wick or close of a candle. And we may face some of the strong bullish engulfing signals qualifying all the rules for bullish candles while we are on seller side. Under that condition also, we are not going to take any bullish trades. Rule number one is very important. Once when we are on the seller side, no matter how strong is a bullish signal, how valid is that, and what might be the winning probability of the call trade, we are not going to take any call trades. Of course, we may win some call trades, and the probability is more that we may lose some trades, which will affect our accuracy. For that reason, we may be avoiding taking some of the strong bullish signals when we are on the seller side. Guys, now we will see how to draw support and resistance. And before drawing support and resistance, I want to tell you something that we have a Telegram group where we can discuss the technical analysis and share our knowledge for free. So if you are interested, please join to the Telegram group where various Telegram team members are sharing the knowledge, their analysis, outcomes and signals there for free. And in this manner, we can exchange our knowledge with each other, and so that new traders can take advantage of experience gathered by the experienced trader. In our team, we have so many experienced traders also who may be sharing their knowledge, their signals every day for free in the Telegram group, and they are ready to help other traders by sharing their knowledge. And in this manner, we may build a good community together, trade together and win together. Now let us see how we are going to draw the support and resistance level. And the Telegram's link is in below the description. Please join that group so that we can discuss. Now let's take an example how to draw resistance and support area. Guys, for me, I think resistance area and support area as the seller's area and buyer's area. Rather than using as a resistance and support, back in the mind, I used to think it as where are the sellers are present and where are the buyers are present. And depending on that, the area where the sellers are present is called as the seller's area, and it acts as a resistance. And the where area the buyers are present is called as the buyer's area and act as a support. Now let's draw a resistance or seller's area to this chart. Actually, this is a Euro USD chart of 5-minute time frame I have taken, and let me see how I can draw a resistance to this chart. Before, here is a line of a resistance area or the seller's area, and you can see I numbered some candles as 1, 2 and 3. Assume that the market is not reached number 3 yet, and the market is after number 2. The market is somewhere here. At this instance, we are trying to draw the resistance level. This is the first line. I draw this first line with a reference to this candle, and I have drawn second line with reference to this candle. I avoided this candle and I selected this candle's close of the wick. Why? Because always remember, while drawing the resistance level, there should be at least one red candle next to the candle which we are considering. For that reason, I am not considering this red candle. Instead, I have considered this candle because I have one red candle next to it and one red candle next to it. Now, assume guys, once you are on seller side, you are willing to take put option and there is some obstruction for your losing. Who are they? They are the buyers. So if we are on seller side and we need to take put option, we need to avoid the buyers. And while seeing this chart, where are the minor buyers are present? You can see after this candle, there are buyers. Here we can see a small rejection here towards the number 1 of the minor buyers area, and next candle is a green candle. So there are some buyers present, and confirmation of this would be as moving ahead, there are still buyers here. So considering that, we need to draw the buyers area. One thing what we need to consider while considering the wicks is upper wicks are sellers and lower wicks are buyers. When drawing the minor buyers area, we can consider a single green candle also as the buyers area because the level is minor. For that reason, I have selected this candle and drawn a level here, not somewhere here. So we drawn a minor buyers area. What if in case if we need to draw a minor sellers area, then that would be somewhere here. This candle is a minor seller area and this candle would be the minor seller area. The close of wick of the red candles would be considered as minor sellers area. So this is how I draw the minor buyers area or minor sellers area, and I have drawn the support line considering the same rules which I have considered for drawing the resistance line. That is, there should be at least one green candle next to the supporting candle which I am going to consider. So I considered this, and number 2 candle I have considered, and draw the support area. And after drawing the line, at least whether support or resistance line should be touched at least 2 times, and on the third attempt we are taking the trade. So this is how I draw the sellers area, minor buyers area and the buyers area. When we are taking put option, we will be drawing minor buyers area, and when we will be taking call option, we will be drawing minor sellers area. That's the key, guys, and we will trade accordingly. If the all rules were satisfied, we are going to take a trade, and we are not going to trade if we get some good buy signals also when we are seller side, and when we are on the buyer side, we are going to avoid the put signals even though the signals are very strong, because the possibility of winning that trade maybe 50-50, and it will affect our accuracy. Let's see how the market will respond to these levels. Please remember that we have drawn the resistance level when the market is somewhere here before the number 3, and we are waiting whether the market will reach the number 3, and we are waiting whether the market will reach to resistance area. And if I found any opportunity towards the resistance area, I'm going to take put option, and I'm not interested if the market will go down and hit the support area. I'm not going to take any call option here because I'm already on the seller side. Don't worry guys, I have some set of rules, some exact set of rules whether to be on the buyer sides or on a seller sides. So I'm going to tell the rules on the next video. But for now, I'm on a seller side, and if the market will reach the support line and forms an engulfing pattern, I'm not going to take. And as we can see, the market went up, took a resistance here, and it is an engulfing candle. My first rule is the body is closed above the 50%. That's true. And at least it have covered 20% of second green candle. That is also true. And there is a distance between the minor bias area and the close of a candle's wick. That's also the true. While my all conditions are satisfied, I'm going to place here a put option, and that may be the winner. Okay, and guys, these support and resistance lines draw by considering this technique is very strong. Rather, though I am on seller's side, I can see some strong buy signals on the support level also. You can see I have drawn a support level by considering number 1 bullish candle and number 2 bullish candle, because I have considered number 1 because it is having a next green candle to it, and number 2 because it's having one next green candle to it. Now what's happened when the market reaches the support level? You can see a nice hammer like candle, even not it's a hammer, but the market reversed from here. So that is the reason why I'm telling you to avoid some of the good signals also to take. When you get that, you may get various buy signals here. You can win them, and there is equal probability that you may lose them, which may affect our overall accuracy. For that reason, we are avoiding any call trades while we are on the seller's side. And in a next slide, I want to show you the stochastic also. The setting for stochastics is 13-3-3. The stochastics also play very important role while selecting any trade. Assume one thing, while we are taking put option, the direction of the stochastic should not be from down to up, whether it is from 50% retracement line or whether 80% level above. If the market is moving, if the direction of stochastic is facing upwards, we are avoiding the trade. We are avoiding the put trade. And if the face of the stochastic is facing down, we may avoid the call trade, no matter about the level. Now assume that you are trying to take a engulfing put option. The stochastic is in the oversold level, but the face of the line is facing towards upside, we are going to avoid that trade also, because the chances are there that the market will break the level and move up, or the chances are there the market will form a doji or a small green candle, and which will affect our accuracy. For that reason, the direction of stochastic is also important. The key thing to here remember is when you are taking a trade, when you are taking a put trade, the direction of stochastic should not be facing up. And in a similar manner, when we are taking a call trade, the direction of stochastic should not be facing towards the downside. Okay guys, so now I have shown you how I will draw and trade. This strategy I follow to trade, and we have a telegram group where we have some very nice people who are following the same strategy, and they are ready to share their knowledge. And so if you want to get an advantage of that thing, you may join the telegram link below in the description. And no matter how intelligent an independent can be, but the group intelligence is more effective than an independent intelligence in any manner. So I hope I have shown you something, and with this video you may become a better trader in future. So that's all for the day, and if you want to see some videos like this in the future, so please subscribe to my YouTube channel. And that's it for today. It's your friend Raj signing off. Bye bye, have a nice day.